What if I told you that investing conservatively might actually put your retirement at risk? Today, we're going to unpack what conservative investing really means and why the traditional definition might be holding you back. Let's jump in and have this conversation. When someone tells me they're a conservative investor, they usually mean one of two things. First, they either want to avoid the ups and downs of the stock market, or they never want to lose any of their money. Now, both of these are fair concerns, but here's the issue. The world of investing often lives in opposite day. Remember opposite day from when you were a kid? Your friend asks, "Hey, can I have your honey bun?" You say, "No way." Then he grabs it anyway and yells, "It's opposite day." That's how financial headlines work. They tell you to be afraid of the market because everything's about to implode. Inflation is up, unemployment is high, tariffs are up and will wreck our economy. I'm not saying these are not valid inputs that can impact our economy and the market. Now, a little side note, the economy and the stock market are not the same thing, but that's another video topic. Every headline makes it sound like the sky is falling, and this leads people to believe stocks are bad. Bonds and cash are safe. But is that actually true? Let's look at the numbers. From 1926 to 2024, the S&P 500 averaged about a 10% annual return. After subtracting the average inflation of 3%, that's a 7% real return. Now, let's look at bonds. They've averaged about 6%, or just 3% after inflation. That's a 4% difference in real return. And over time, that difference is massive. Let's think about inflation for a minute. We will assume a rate of 3%, as I mentioned earlier. As you and your spouse embark on a 30-year retirement, it's likely one of you will live that long. What will the price of a gallon of gas be in 30 years? Well, gas is about $3 per gallon today. Inflating $3 by 3% for 30 years gives you $7.30 per gallon. The average fuel tank size in the U.S. is 18 gallons. Today, this costs you about $54 to fill up your tank. In 30 years, it will cost you $130 to fill up your tank. Bonds cannot keep up with inflation and your withdrawals to fund your lifestyle. It's just not possible for most Americans. Think about it. With the 4% withdrawal rule, if bonds have a real return of 3% after inflation and you're withdrawing 4% from your investments to live, you're going backward 1% per year. Stocks have a real return of 7% after inflation. If you're withdrawing 4% from a 7% return, your funds are still growing an average of 3% per year. This allows you to fund unexpected events and leave a legacy for your family. Here's the truth. If your goals are not to outlive your money and leave a legacy for your loved ones, you need to grow your investments faster than inflation takes from them. In bonds, well, they struggle to keep up, especially with healthcare costs, which have an average inflation rate of over 5%. So, what does conservative investing really mean? It means beating inflation, protecting your purchasing power, being able to maintain your lifestyle, and fueling your life goals and the goals of those you love. That's real conservatism, measured, thoughtful growth that serves you long term. Let me ask you, are you basing your investment choices on your goals or just trying to avoid short-term market swings? Because those are very different strategies, and only one will likely get you to where you want to go. If your dreams are bigger than avoiding short-term market swings, then consider stepping out of opposite day and into a plan that's grounded in truth, not fear. Take some time to review your portfolio, your investment policy statement, and your financial plan to ensure what you have planned will achieve your goals. Thanks for watching. We'll see you next time.